Well, good afternoon, everybody. I'm Erich Patten, the Chief Investment Officer here at Cutler Investment Group, and I'm joined by Stanley Barnes, a Chartered Financial Analyst and Associate Wealth Advisor here at Cutler. And we're here today to talk about Cutler's second quarter review and market outlook. So let's jump right into it. One thing that we think is important to note is that new information becomes available all the time. And in fact, we saw it very much over this last week with both an assassination attempt on President Trump, as well as new CPI data, can change the market dynamics fairly quickly. And as new information comes available, we're going to change our views. So we just advise you to talk to your Cutler advisor. Reach out if you have any questions, how anything in this presentation might apply to you. Let's talk through it and make sure you're positioned appropriately. So today's agenda, we're going to start with a market review and an outlook. We've titled this "The Bull Keeps Running." 2024 has picked up right where 2023 left off. The S&P is up significantly thus far this year. Then we're going to move on to an economic outlook. We're going to talk about the Fed, what's happening with inflation, as well as are we going to have a recession? How does the economy look from here? And then finally, I know there's a lot of regulars on the call today. Last quarter, we promised that we would talk about the election. So we're going to jump into investing around the election. What should you be doing in your portfolio? How should you change things or not based on who you think is going to win the election? All right, so Stanley, can you walk us through our second quarter and tell us what happened and what Cutler thinks how clients should be invested?
Yes, so starting off with bonds. The March CPI came in a little bit high at 3.5%, slightly above what the Federal Reserve was expecting. As a result, the bond market went down quite a bit. Since then, CPI has come in quite a bit cooler, a little bit below the Fed's expectation, and the bond market has rebounded. So far, year-to-date, bonds are roughly flat, and CPI has been coming down, so we'd expect interest rates to fall in kind over the next few months. As far as the equity side goes, quarter one saw broad market participation pretty much across the board. Quarter two really reverted back to the artificial intelligence trade and what happened in 2023 with the large cap growth stocks and on the tech side especially doing very, very well, and the rest of the market lagging behind a decent amount. And then with foreign equities, there's been quite a rally in foreign equities as well. That's despite a strong US dollar. There's also been some market dynamics there as well with growth versus value and a couple other items too. And then finally, with alternative assets, there have been strong risk-adjusted returns. Cutler does view this asset class as a little bit redundant now that fixed income yields are a little bit higher. So we might be transitioning a little bit more towards fixed income, a little bit less towards alternatives given the higher fixed income yields. What I really want to point out is this chart on the right, and this shows our investment committee's asset class convictions for each individual asset class. So as an example, looking at US large value, these convictions range from -3 being bearish to +3 being very bullish. US large cap values at 0.4. So we're slightly bullish there. That's, as compared to global REITs and alternatives at -1.8. We're more bearish on those areas, just given the lower yields and the higher fixed income yields. And then if you look at US mid blend and international large cap blend, those are the areas we're most bullish relative to the rest of them.
All right, so let's talk about what's happening in the stock market. And in the second quarter, year to date, again, Stanley mentioned the 2023 artificial intelligence trade was back on, and you can see large cap growth stocks at 20.7% led the market higher. That's been a theme over the last decade. We've seen large cap growth really be the driver of stock market returns. All the way down at the bottom of this chart, you see bonds are down 0.71% through June 30th. That's largely reflective of those changing interest rate expectations and really that dynamic inflation situation. We'll talk a little bit about that later in the presentation. But as we look at large cap growth in terms of how it relates to the rest of the market, the Magnificent Seven has really been a driver of stock market returns. The Magnificent Seven: Apple, Amazon, Alphabet, which is Google, Meta, which is Facebook, Tesla, Nvidia, and Microsoft. Those seven stocks have been 61% of the total stock market returns this year. Last year, they were 63%. You can see they've been an increasing percentage, increasing influence on investor outcomes. And so what does that mean for investors when the large cap growth portion of the market and those top stocks have become a much greater percentage of the overall stock market. Look on the top right. You can see the top 10 stocks are at an all-time high concentration, about 37% of the S&P 500 in just 10 companies. But compare that with the bottom right, the earnings contribution of these 10 stocks is only 26%. So clearly they have elevated valuations. And you can see that here on the left side, the top 10 traded about 30 times. The other 493 stocks trade at 17 times earnings. So we see some opportunities out there. We think that, yes, you should own growth. Absolutely. You can't be an investor in the US stock market and just ignore the top 10. But you should also look elsewhere for opportunities. And those other 493 or other asset classes that we'll talk about later really present an opportunity. So Stanley, can you talk us through the S&P 500, really how we got to where we are and what the valuations look like?
Yeah, so looking at this graph right here, it shows the S&P 500 returns over time. And as everybody knows, we've reached all-time highs a number of times over the last few months. The S&P 500 continues to go up over the last year to year and a half. What I really want to point out is the January 3rd, 2022 figures versus June 30th, 2024. If you look at the price to earnings ratio, the PE ratio has gone down from 21.4 to 21. And then the dividend yield's gone up from 1.3 to 1.4. So overall, even with the S&P 500 growing higher, we've also seen corresponding profit growth to the point where the price to earnings ratio has actually decreased. You're buying earnings at a cheaper valuation than you were a year and a half ago. And the dividend yield's gone up too. So even though the markets continue to go up, earnings have actually gone up even more, slightly more than the market as a whole.
Yeah, so Stanley, with the S&P having hit 30 all-time highs this year, is now the time to sell your stocks?
No. And right here, looking in the dark blue, that would be if you invested in the S&P 500 on average just every single day, no variation in amount invested, which day it was, versus in the blue, if you invested at the all-time highs and only the days that the market had an all-time high. And what we see here is if you actually only invested on the days of all-time highs, you would have better performance over the 1 year, 3 year, and 5 year periods than if you did it on random different days. And the reasoning there is market momentum. As the market goes up, it continues to go up more and more and more. There's really that momentum factor where the economy is growing, businesses are producing profits. It becomes a self-fulfilling prophecy where the market continues to shoot up. And so when the market keeps on hitting highs, it's actually better to invest then than to hold back.
All right, so that's a summary of where we are and how we got there. And now let's talk about the Fed. We call this next chapter Fed Watch. And while large cap growth has largely been rallying on this artificial intelligence trade, the rest of the market is still very much dependent on interest rates, on inflation, on economic activity. So these next few chapters are going to deal with the rest of the market, other asset classes that might be influenced by these outcomes. And on this page, there's a lot of words. We have two headlines. 3.5% was the CPI that was released in March. Minus 0.1% on the right side is the CPI the month-over-month CPI that was released recently, just last week for June. The 3.5% on the left was higher than expectations. Expectations were at 3.3, and we drew an arrow directly to this rise in the 10-year Treasury yield. You can see, at the beginning of April, the 10-year was close to 4.5%, and then it spiked up to near 5% as inflation data came in hot. Well, since then, inflation has cooled off, and you can see gradually the 10-year Treasury has moved lower. And then, in fact, last week, it dropped almost overnight from 4.6 to 4.5 when the June data came out. So we've seen some change in the inflation dynamic that has really brought interest rates lower. But what else has it done? We put a new chart on this page. It's on the bottom left. This is the iShares Small Cap ETF. And you can see in March, it was trading near $110, and then it dropped to about 104. So that March data really hurt small caps. Well, what did the June data do to the small cap space? Small caps are up almost 10% over the last week, largely on the heels of this softer inflation or cooler inflation data. So you can see inflation matters. It continues to influence the market greatly, not just our pocketbooks, but also companies that we might invest in. Stanley, let's talk a couple slides through of what is inflation and what are the components, how is it working right now?
Yeah, so looking at this graph, this is the CPI for all urban consumers over time, really what the price level is. And as you can see, it generally is increasing consistently. There's a couple periods where it might go down, during the financial crisis between '07 and '09. But generally speaking, it is an upward trend. And that's because even with a lower inflation rate, going from 9% inflation in 2021, 2022, all the way down to about 3.5% right now, you're still getting price increases. It's just increasing at a lower and lower rate. So we saw a large acceleration in inflation in 2020, 2021. And since then, you'll see it's decreased, still increasing at a somewhat elevated amount, but not as much as it used to. And the main point here is even if the Federal Reserve reaches its 2% inflation target, we will still see increasing prices just at a decreased rate of growth. And then right here, we're looking at the chances of a Federal Reserve rate cut. So currently we're in the 525 to 550 basis point range. You'll see for these meeting dates on 07/31, there's about a 91% chance of the Federal Reserve not cutting rates and staying in that range, about a 9% chance of having one rate decrease by 25 basis points. Now, as time goes on, I'll get all the way to July 30th of 2025, the chances of more and more rate increases or decreases gets more and more likely. So by the end of 1 year from now, we're expecting about 1.25% rate decrease, or at least the market is, and we'll see if we actually get there. But the main point here is the Federal Reserve should be cutting rates over the near future, over the next year, 2, 3, 4, 5 rate cuts. 1.25% is expected. Definitely 1 or 2 rate cuts over the next 3, 4, 5 months. And then on the right,
sorry, a couple of points on this chart. We asked the question, will we actually get 3 rate cuts this year? That chart on the left is really forecasting 2.5 rate cuts this year. So it's kind of a coin flip whether or not we get that third or not. Cutler would err on the side of not getting that third cut, largely because Jerome Powell has been a higher for longer Fed chair. That's been the Fed stance. We see him focused on inflation. The Fed really wants to see inflation getting to 2%. Now, of late, Fed has been increasingly focused on unemployment as well. So the Fed does have a dual mandate. The mandate is stable prices, as they define 2%, and full employment. And with the unemployment rate rising from 3.5% to 4%, now the Fed is starting to focus more on the labor market and maximizing employment. So that's the reason the market's forecasting some cuts, but the degree of the cuts are really what's up for debate. Stanley, walk us through the components of inflation, really what's been driving these numbers and what we might see for the rest of the year.
So this chart right here shows the CPI month over month through June 30th. And what we see is if we go 2/3 of the way down, looking at all items, there was a negative 0.1% decrease. So overall, inflation was a little bit negative, very, very slightly. And this tends to change a little bit month to month. The 2 main things I want to point out are if you look at the very top, natural gas increased 2.4%. And then second from the bottom, gasoline, negative 3.8%, both in the energy sector. Energy and food tend to be very, very volatile within CPI. Prices are increasing, decreasing, generally a lot more so than the economy overall. And so generally what the Federal Reserve does, they strip out energy prices as well as food items, and they look at core CPI. If you look at all of the other items, everything was pretty much in line with, pretty flat inflation. We range from 0.9% to motor vehicle insurance, but most items, are in that plus or minus 1% range. There really isn't a massive change month over month, which means that inflation really is kind of petering out. And we're getting down to that 2% inflation target that the Federal Reserve wants to hit.
All right, so let's talk about the economy. And this chapter is called Key Economic Indicators. We're looking at some of the big picture indications on whether we're going to have a recession or whether we're going to have growth. Stanley, well, before we move on to this chart, I will pause here and just say there's a little bit for everybody here. There are some negative indicators that suggest a recession could be coming, but there's also some very positive data out there. So it's a little bit of a mixed bag, and we're going to walk you through that right now. So Stanley, can you talk us about through the yield curve? Why does the yield curve matter? What is this chart that we're looking at?
Yes. So first of all, the yield curve. What the yield curve is it shows U.S. government treasury bonds and their yields for 3 month, then 6 month, 1 year, 2 year, 3 year, 5 year, 10 year, all the way up to 30 year. And generally what you see is the further out you go in the maturity of the bond, the higher the interest rate, just because there's a little bit more time risk, a little bit more interest rate risk the further you go out. Now, when you have an inverted yield curve, it means that short-term rates, that being the 3-month rate, is actually higher than the 10-year treasury bill rate. And that's pretty rare that it happens. And generally what it means is investors don't want to invest for the long term. There's a lot of fear in the market. And so you get a lower interest rate for the long-term bond than you do for short-term bonds. That generally means a recession is upcoming. And what's very, very interesting about what's happening with the current inversion is this is the longest treasury curve inversion we've ever had in the history of the United States. It's been over 425 trading days at 437 days, close to 2 years. Keep in mind, not every single day is a trading day. There's about 250 per year. And so what we're looking at is the longest yield curve inversion of all time without a recession. If you look at this graph here, in the light purple, those indicate recessions. Every single inversion beforehand has actually led to a recession. We haven't had that yet. We've actually had some pretty strong periods of economic growth ranging between the 2 and 4% range over this inversion, which is really unheard of.
Yeah, Stanley, this economy has continued to defy expectations. Here's another one that it has defied. This is the Purchasing Manager Index. Below that black line is considered contraction. Above that black line is considered expansion. And you can see we've been contracting in manufacturing for 19 out of the last 20 months. That's been a fairly strong recession indicator in the past. What about the leading economic indicators index? We've shown this in the past as well. Usually this is pretty well correlated with the S&P 500, but it's deviated over the last couple of years. Why? I think the biggest explanation as to why is the artificial intelligence trade. Those 7 companies have been pulling the stock market higher, but the other 493 companies might be tracking this yellow line a little bit more closely. And this yellow line has been indicating recession for quite some time. All right, well, what about the good news? We've showed you these recession warnings. The good news is that the economy has continued to grow, and this is hot off the press just from yesterday. The Atlanta Fed's GDP now estimate for the second quarter is 2.7% growth. We've seen growth as high as 4% over the last couple of years, but 2.7 is definitely not recessionary growth. It's an environment, especially with an economy the size of the U.S. economy. 2.7 is very robust. So there's good news. Companies continue to grow. The economy continues to grow. That brings earnings up, and valuations look more and more attractive as earnings grow. All right, so we gave this away. We spilled the beans a little bit in the beginning when we talked about our convictions. Stanley, we asked the question, is international a good place to invest? The answer was yes, but why? Can you walk us through some reasons why we think that this is true?
So looking at this graph here, we have the non-U.S. equity markets relative performance, underperformance, and outperformance relative to the U.S. In purple, we have the non-U.S. equity market outperformance, and then in gray, we have periods of U.S. equity market outperformance. So as an example, from 86 to 89, 1986 to 1989, the non-U.S. equity market heavily outperformed the U.S. And then if you look over the more recent era, between the financial crisis and 2020, the U.S. market heavily outperformed, mainly because of the tech companies. Now, since then, there's been a little bit of trading back and forth between the two, not massive outperformance from either side. But the whole point here is there's going to be periods where the U.S. outperforms, there's going to be periods where non-U.S. outperforms. And what we really want to do is we want to reduce the overall volatility of your portfolio and get those long-term expected compounding returns. And that's what we have, that international piece. Over the long term, U.S. equities and non-U.S. equities should have roughly the same performance, but it's not going to be all at the same time. Now, looking right here, we have sectors versus asset class performance. And what I really want to point out here is the U.S. is very dominated by the tech sector, which is not quite as true of non-U.S. equity markets. And so right here, if we look at the purple versus green, looking at the Asian tech sector versus the U.S. growth companies, which are largely dominated by tech, they perform almost completely in line with each other. If you look at 2015 through now, those lines almost completely overlap, and they're very close to each other. They've had almost exactly the same returns over that period. Now, if we compare that to the European renewable energy sector, European luxury goods, Europe biotech, those are the three of the largest sectors over there. There's been a lot more volatile performance, a lot bigger ups looking at the European renewable energy sector, but a lot bigger downs too. And so the point there is the differentiation in equity returns between different regions is a lot more due to sector performance than due to actual economic performance. And then right here, looking at opportunities around the globe within the semiconductor business, if you're looking at manufacturing and semiconductor production, back in the 90s, it was really three main regions doing the vast bulk of the production. It was Japan, Europe, and the US. Since then, there's been a lot more global diversification in where semiconductors are produced. So now we have China at 24%, Taiwan at 21%, South Korea at 19%. There's a lot more regions producing semiconductors, and it's become a lot more globally diversified. Because of that, there's more competition. Yes, for the high-end chips with NVIDIA, there's been a lot more price increases and a lot higher costs. But those prices would be expected to come down as some of these other countries and other regions get into that high-end chip production. We start seeing a lot more competition eating away at those profit margins. And then right here, looking at diversification, this shows the economic indicators above and below expectations relative to what the analysts expect. So in orange, we have the Eurozone. You'll see, for example, in July of 2023, almost every single economic indicator was coming below expectations. Basically, sentiment was dour there, and all the indicators were coming in well below expectations. Since then, there's been a rebound where the actual indicators and all the regions are coming in decently well above expectations. It's been a reverse story for the US, whereas back in July of 2023, all of the indicators were coming in above expectations. Since then, there's actually been a degrading of the indicators, where now most of them are coming in below expectations. So we've really seen this reversal where non-US equity regions were really coming in below expectations, and now the US is the one coming in below expectations, and non-US is coming in well above expectations.
All right, thank you, Stanley. In this last chapter, we're going to talk about politics, and we jokingly say, "Please be kind." But Cutler, we advise over 2,000 individuals company-wide. And as you can imagine, we have clients of every political belief you can imagine. We see our view as advisors of taking an objective view, of kind of taking a step back from the politics and saying, how can we position your portfolio objectively to meet your goal? And really what I'm talking about are biases, and we all have them. And you can see here on this chart how political biases might play out in terms of how you think about the economy. In red are Republicans' opinions of the economy, and in blue are Democrats' views of the economy. And you can see during the Bush administration, Republicans thought the economy was doing great. And then during the Obama administration, Democrats had a much more favorable view of the economy. And then in the Trump administration, Republicans thought the economy was better. And then in the Biden administration, Democrats thought the economy was doing better. So you can see, regardless of who's president, your outlook on the economy can be clouded by your political beliefs. Now, what we would advise is to take a step back and think about the stock market. The stock market's made up of individual companies that are made up of thousands and thousands of people. And each of those people are going to work every day trying to add value for shareholders, trying to grow their revenues. Apple wants to sell you an iPhone no matter who is president. And NVIDIA wants to sell Apple chips no matter who is president. So keep that in mind. Take a step back from your political beliefs and look at the stock market as an investment and really not as a political vehicle. If you had not done so, say back in January of 2021, Biden got elected and you thought, I'm going to invest for a Biden presidency, what would you have done? You might have bought clean energy and sold oil. And this chart shows that the results actually turned out the opposite of what you might have expected under a Biden administration. You would think Biden would be favorable for clean energy and hostile toward oil, or more aggressive toward oil companies. And if you look at this chart, oil prices went up 122%, and clean energy stocks went down almost 50% over that time period. And that just goes to show that a president can influence policy, but that policy doesn't necessarily translate to shareholder returns. Let's look past what the president says and focus on what you should be doing in your portfolio. So looking forward to November, Stanley, this is a lot of pennies here on the page. Talk us about what we're looking at right here.
So this is from Predicted, which is a political gambling website where you can look at the people who are buying and selling based on who they expect to win the 2024 U.S. presidential election. What we see here is currently market expectations are that Donald Trump has about a 69% chance of winning the election, and then Joe Biden, 25%, Kamala Harris, 12%, Gavin Newsom, 4%. Now, obviously, with Kamala and Gavin, there's some factoring in that perhaps Joe Biden does step down as the Democratic nominee and Kamala Harris or Gavin Newsom would be the two most likely people to step in his place. But what we really see is it's about a 65 or 70% chance of the Republicans winning, a 30 to 35% chance of the Democrats winning, and that's as of right now. Keep in mind, these chances change over time. The election is likely to be very, very close. It could swing one way, it could swing the other way. Right now, it really is a toss-up, but this is just to show that, hey, currently this is where we're at. It will change over time, one way or another.
Yeah, and Stanley, if Biden wins, we're likely to see a continuation of current policy because he's the incumbent. If Trump were to win, we might see a change. So let's talk through what those changes might look like if Trump were to get elected. We've highlighted three here on this page. The first is deregulation. The Supreme Court recently reversed precedent with it's called the Chevron decision. The Chevron decision allowed federal agencies to make policy within their realm of expertise. And the Supreme Court has now said those agencies need to defer to the judicial branch. So that makes it a little bit harder for those agencies to implement regulations. And we might see the Trump administration use that momentum to try to reduce regulation in many industries. And one that would stand out would be energy. Trump has talked extensively on the campaign trail about the energy sector and favorable of drilling, for example. The second Trump economic priority is trade, and he's proposed a 10% across the board tariff. And this is to protect domestic industries, but it also would likely put pressure on interest rates. And, on Monday, after the assassination attempt, there was a great deal of speculation that Trump is going to win the election. And those odds on that page we showed previously jumped higher on the likelihood of a Trump presidency. What did we see the markets do? Well, notably, we saw long-term bonds sell off, right? And I think that sell-off, that steepening of the yield curve is very much related to this second bullet point here, this trade impact. What's the third economic priority? And this is something we're going to see under either president, I think. It's action under the Tax Cut and Jobs Act. Stanley, walk us through the TCJA and why both Biden and Trump are going to make it a priority to adjust tax policy next term.
So the TCJA was passed by the Trump administration during his previous presidency, and it is set to expire at the end of 2025. And really what it did was it lowered tax brackets across the board by 1 to 2%. It also doubled the estate tax exemption from about $7 million to $13.6 million per individual. And then it also lowered the state and local tax deduction to a maximum of $10,000. And all of these are set to expire at the end of 2025. Now, it is very likely that regardless of who wins the election, some of these items will get passed to continue on. And then depending on who wins, some of them may expire and not get passed.
Yeah, so on this side, Stanley, we're looking at the tax brackets currently, as well as if the TCJA were to expire. Anything jump out to you on this page?
Yes. So one of the main items to point out is every single tax bracket will either jump up by 1 to 2%, or we'll see the income levels for those tax brackets decrease if there's a full expiration. So as an example, for the 12% tax bracket, that'll jump up a little bit. The 37% tax bracket, that will go from 37% to 39.6%. On top of that, the income level for married, filing, joint will go down from 731,000 to 583,000. Again, nobody likes tax increases, but obviously taxes are needed to fund the government too. So we'll see what that looks like. I would say it's likely that if Trump wins, they'll try and extend all the tax cuts. If Biden wins, they'll probably try and extend the lower tax bracket cuts, likely letting the higher tax brackets go back to their original bracket levels. And then I'd also point out that the standard deduction is another big one. That got doubled from 15.75 thousand for married, filing jointly up to 29,200. If that expires, that'll get cut back in half, which means a lot more people will be itemizing. There'll be a little bit more higher taxes. That's probably another one that the Democrats may look at extending if they win. If Trump wins, he will definitely look at extending.
Yeah, so as we look at this information here, I think there's really two pertinent questions for Cutler clients. One is, can you take advantage of that estate tax exemption with the possibility of that changing? Is that something you should be accounting for? And two, we really like to see clients when they're in these lower marginal tax rate brackets, and sometimes that's only for a few years in their retirement, but take advantage of those lower brackets, perhaps by filling them with a Roth conversion. And so these are moving targets, and they're gonna change under each administration. But talk to your advisor about how that might be appropriate for you and how you might be able to kind of maximize your post-retirement after-tax income through a Roth conversion in one of these lower margin brackets. All right, so last political point we're going to talk about, because it's been such a hot button issue over really since the pandemic. Will debt improve under either candidate? And we say don't count on it here. Perhaps the rate of increase will change, but the debt getting lower is not likely to happen. The current national debt is $34.6 trillion for each of us on this call here today. That's $102,800 per person. And the average interest rate that the government is currently paying is 3.2%, and the annual interest expense is 1.13 trillion. And this is it can be a scary number, but keep in mind the U.S. has 180 trillion in consumer assets. We have a lot of assets backing up this debt. But just as with income and interest in your stock portfolio, that can be cumulative over time, and you can see the compounding value of those cash flows. The opposite is true with the government debt, where it compounds a negative value, right? So the annual interest expense is 1.132 trillion this year. That's going to be 3.27% higher next year if the government balances the budget, which we all know they're not going to do. So that means next year it compounds a little bit higher, and the year after that it compounds a little bit higher. And what that does is it crowds out interest rates. So long-term interest rates, we get the question all the time, are we going to see your mortgage rate drop back to levels of 2020, 2021? Not likely. The one reason is that was an exceptionally harsh economic environment, and the Fed lowered rates dramatically to stimulate the economy. But secondly, given the levels of government debt, it has crowded out private investment to the extent that interest rates are not likely to see those levels, in our opinion, ever again. You might see the 10-year drop down, to 3% or 4%. That would be reasonable, but we're right near historical averages here today. So we don't see dramatic changes in the bond market. That's one of the reasons we're comfortable with bonds and investor portfolios today. All right, so Stanley, sum it up for us. Should we sell our stocks? Our clients know what you're going to say, but should we sell our stocks because of who we think might get elected?
No, absolutely not. Looking right here on the left side, we have unified Republican-controlled government. So that's the Republican president, House, and Senate. Right below that, unified Democratic House, president, and Senate. If you look at the returns on the right side, unified Republican, 14.52% on average over time. Unified Democrat, 14.01% over time. That is not a statistical meaningful difference. Regardless of who's in control of the government, equities tend to have positive returns. Even with divided government, there's positive returns for every single type of government control on this chart. The point is, business produce profits over time. They tend to have positive returns, and that's going to be true regardless of who's in the White House, regardless of who's in control of Congress. Because again, businesses are profitable, and frankly, they're not trying to, play who's in the White House or who's in government. They're trying to produce a profit and sell you products and services.
Yeah, so and I mentioned several times in this presentation, you reach out to your advisor, ask a question about this. Here's a list of questions you might want to talk to your advisor about. And really, we want to know what's on your mind and really be there as a resource for you for all of these questions. So with that, I just want to say thank you for joining us today. Stanley and I are happy to talk through any of these items directly, or you can talk to your advisor at Cutler about them. Have a great summer. We'll talk to you in the fall with a summary of what happened over the summer. And thank you very much.